In our last video together, we discussed the idea that maybe Wall Street was starting to buy the dip. Dark pool liquidity was showing us huge transactions, and that's exactly what happened on Friday, with big market moves that lead us to believe that maybe even a dead cat bounce has happened. This week is marked by some of the most important earnings season records in 2024. And while big tech is going to be announcing, we still haven't seen oversold levels on every indicator that you would expect. Could markets have a secondary trap in them this week? Well, today we investigate that together, along with what's going on with the VIX, whether it can hit 20, and when breadth improves on the Russell and decreases on the NASDAQ, does that mean anything about where we're at in terms of the cycle on markets? Stocks, commodities, and cryptos for the week ahead. Let's get into it together, guys. Well, welcome back everyone to the special weekend edition. My name's Tom. Today we're going through what happened on big tech, what's going on the breadth rotation, and of course the macro and the data that we all need to be looking at as traders and investors. If it's your first time here, welcome, subscribe to the channel, smash that bell icon. But let's get into the first story today, and that's of course behind the data. What exactly is going on in this market? By now, you're probably aware that the 50-day moving average has been broken below. And a lot of people see that as a hugely negative sign. One of the most popular moving averages, often cited in some of those reports by big tech houses, has been closed below. Very negative, right? Well, as it happens, the data stats tend to suggest a little bit differently when we came from a very high point. We were over 5% above the 50-day moving average only a few days ago, and then in less than 6 days, we've gone and closed below it. Now, there aren't too many stats here that come through, but you can see here Seth Golden's report shows us that according to the data moving forward, 6 months later, we were at 100% bullish probability of an average of or mean of 9.9%. Also, 12 months later, another interesting stat was that while it ran, it was often close to a bit of a turning point, with a lot of markets turning quite negative at that period. Now, if you're a bit of a cycle believer like I am, and you'll see a little bit later on in today's video, then maybe this is suggesting that once we get past the election, that actually could be a problematic point for the markets. And of course, that takes us into 2025. So would that be making sense when we look at normal election years? Well, this year is not so normal, as you'll find out in a moment, but it does suggest that if we had a sell-off, which happens at the back of July in normal election years, then we tend to go to a rally during the month of August, one of the strongest months of the year. And as you'll notice here, it is usually quite positive. Now, July is probably going to end negative on the Qs, and that's the first time it's done it in 10 years, which is a surprising stat. But September and October can be very volatile, and November tends to actually bring the bulls in normal election years. Where things go different, though, is if we have what we call a lame duck event, where basically the current incumbent president is either finishing their term or they're not running for the election again. And that's the type of thing that we're seeing here in 2024, although this time might be quite different because, of course, it would be likely that Biden's team will not do anything to really hurt Kamala Harris's overall chances to try to win the election. But this is an interesting point because in most years during elections, we'll see a pickup in August. But if we are in the lame duck year, August actually turns quite bad and the market ends up going negative all the way until the event ends up going through. So, of course, the November elections. That's an interesting data point. But again, we have so many other ones that we need to discuss. First up here, this chart that we shared from Jason Gopfert that basically told us the same thing as the first one did. 6 months later, when we see effectively the RSI drop the way it did very quickly, usually we see recovery, heaps of data points, and it's 81% of the time at a median of 10.7% return. So very similar to that 9.9. Does this make sense though when we think about sentiment? Everyone was really bullish only a few weeks ago, and as we thought together, we would probably see the bears return. Now, these reports come out Thursday, but they are actually done as of Tuesday. And what that means is it needs to come through. Things need to flow through. And what I feel like, and I think a lot of us do, is that neutrality is going to come back into the markets over the next week. When we see this return next week on Thursday, then you'll end up seeing bulls less, neutral probably much higher, and bears probably sitting around 31 to 35%. Now, will that mean that the bottom's in the market? Certainly shows that sentiment will have shifted quite a lot, and that would be consistent as well with the types of levels and the type of pullback that we've seen on the S&P 500, the 38.2 fib, and of course the extensions that we saw in the last correction period. If you're an Elliott wave believer, it could also be a very, very good level around these points for bulls to return back into the markets. But there are some other problems on hand. Of course, we've got the interest rate cuts. Are we going to see a cut? More importantly, what does the cut structure mean to us? And you can see here this Goldman Sachs report shared by Mike Zaccardi over on X basically shows their baseline and their overall consecutive cut theories. And this is what the market's currently pricing in. The idea that we get cuts in a consistent basis and hit a terminal rate somewhere between 3.5 and 3.7% sometime in 2025 to 26. Now, if the Federal Reserve comes out and they do a double rate cut at any point, or they consistently drop it really, really hard month on month on month, and for whatever reason the markets continue to go up, remember that is an absolute huge warning sign. If the Federal Reserve panic, you should be panicking even more because it means that there is something very wrong in the economy. We just don't know about it yet. That black swan style event that would come through. But really, I think the change is in the FOMC statement. Now, Goldman Sachs expect a few different changes, and I would agree with them. I don't think the Federal Reserve is going to get their 2% target, and the core PCE actually ended up ticking up a little bit in inflation. So instead, they're going to change their copy-paste reports that they've been putting out for us, and they might say something like, oh, we're going to have a somewhat greater confidence to continue reducing its holdings in treasuries. We basically expect that inflation is probably going to move sustainably towards 2%. Not that it has to, but instead that they think it's going to, or it's getting close to that point. Now, if they change those words, the markets probably will like it. Why? Well, they know that, like the Federal Reserve has continued to done through the last couple of years, they will support the market at any cost, and until something goes really wrong and they can't do it anymore, basically they're always going to be there as a buyer of last resort. And this has also happened when you've got those kind of bullish years. And generally speaking, how do you tell a really bullish year? You don't get too much volatility. And up until recently, we haven't seen many 2% days. In fact, look at this. It's been basically none. And we know that if you have low volatility throughout time and you have less than 5 days of 2% drops in a year, then usually the forward point, that is over the next year of actual data, you end up having another 14% added onto the markets. So again, another big bullish data point that we're seeing here in markets. What about July? Could it have been the peak? It could have, but it's unlikely. Usually markets don't peak in July or August. In fact, they generally peak in December and January. And I think this is a great one for you to take a report on, or maybe like a picture of, because this Carson piece of information is always helpful whenever you're seeing peaks in the market moving forward. Another bullish stat that we've seen come through has been the Whaley breadth thrust. This breadth thrust is pretty incredible, and I never discount Zweig breadth thrust or Whaley breadth thrust because they have incredible track records. 100% of the time since we've ever seen these particular ones, we have a bullish market, and 24% overall median return is had. Now that's very bullish, and it suggests that there is more to come, along with this chart from Grant Hawkridge that we've been looking at, which basically shows that the Russell 2000 may be in its over performance mode area. Remember, all of 2023, the Russell 2K sucked. Now it looks like it's coming good, and it is almost year to date actually overtaking the Qs, if you can believe it. 12% versus about 15% at the time of this recording. That's pretty mad when you think about how far behind it was at one point. So are we in the last innings of the cycle? Well, we'll look at this versus the Qs in a little bit later on the video, but basically, yes, it does tend to suggest that we're in that point where it's a buy everything rally, and market traders and investors and everyone doesn't really care too much about necessarily anything in particular. They just start buying things because they believe the economy is going to improve. Probably it isn't, but they believe it, they forecast it, and that's kind of what we call like a bit of a curse that happens in these markets. If we think about VIX term structures coming into the back of the year, it would make sense that we might even have what we call the lame duck event. So that's one we've got to be careful of, because the VIX was, of course, predicting that August, September, October into November was going to be volatile. Now that suggests that we have very, very volatile election. We could be following that path that we've not often seen, but when we do, tends to be a lot more volatile. We'll have to be on the lookout for that. And of course, we should know it over the next 2 to 3 weeks. What about earnings announcements? This is the biggest news this week. Of course, Apple, Microsoft, AMD, Amazon, Meta, just to name a few, are coming out. Each day of the week's important. This is the biggest earnings week overall in terms of market capitalization size, and it's going to lead into some very interesting results. But so far this earnings season, one of the biggest numbers that's come out has been that S&P 500 companies that are reporting with more revenue outside of the US has realistically shown very, very, very good results. So there aren't too many companies that actually earn over 50% of their revenues outside of the US, but info technology, materials, communication services, and consumer staples all have possibility of actually earning 50% or more outside. And I think that's an interesting stat so far this earnings season. When we look at the vol, be warned, there are some big ones. And this chart's actually going all the way up to plus minus 12%. This is what the options market expects the stock to do on the day. Microsoft first up, around 5 to 6% move. AMD's around 9 to 10% move. PayPal the same. Starbucks 8-ish%. And Apple is expected around the same as Microsoft at 5. So we've got some big volatility. Meta's probably the biggest of the major names at around 9%. And this means that most likely hundreds of billions and maybe even $1 trillion of movement will occur in this coming week based on just the earnings themselves. And the earnings progression is very, very important. We know that most people expect that earnings markets are going to be continuing to improve. The overall trajectory is that markets will do better in 2025, according to the forecasters, than they're doing this year. And most expectations are now being put on the Russell 2000 stocks. They have to perform specifically in 2025. And if they don't, things are going to go absolutely haywire and bonkers. When we look at sector earnings progression, you'll notice that financials are doing really well. Technology, of course, has been doing incredible at this point. And everything turned back in 2022 into 23. And that's what's led into this current bull market. But I want to talk about the dark pool liquidity, because really dark pool liquidity has been driving some of the big trades, and it's been showing us the buy the dip areas, and it's also been showing us some of the sell the rip areas. So first on is Bitcoin. Now Bitcoin had a monster transaction in it. There's not much history here, but the Bitcoin ETFs are starting to get some big flows. We had a massive flow over here only a few weeks ago. The market dropped and then it recovered, and we just saw the number one print come in at the close. Now that could suggest that this is in a overall Wyckoff pattern, which we've talked about for a while, leading to Bitcoin making a new all-time high, and maybe that's someone trying to get on the rip. It also could be a sell because we're getting closer to the peak, but if it consolidates here, breaches out, especially a nice weekly close, I think it's a great sign that Bitcoin is starting to do better. Some other big ones have to do with the Qs and of course the semiconductor markets. First up, we've got the NASDAQ here, and you'll notice that there's this random dark pool cloud, little ghost sign kind of thing going on here. And what this basically is showing us is that someone actually made a transaction at a price higher than the market even went to. Now, I don't know exactly why anyone would do that, but it happened. And you can see here that if the market does end up breaching through that point, that is important, although they are pretty offside at this stage. So the market taking this high, as we'll see later on when we look at the technical analysis, will be an important factor. Daily semiconductors and pretty much anything to do with semiconductors has been wild in terms of big transactions. We've probably just seen the profit taking of semiconductor shorters. Why? Well, they were getting big in on the shorts recently, which we saw. Now they've most likely taken profit. The number one print over the last 2 years, that's the largest trade over the last 2 years, has gone through on the 3X fund. And that suggests a TP of somebody that was pretty heavily short semiconductors. Same kind of thing when you look at the 3-time bull funds. Someone's been, what you would think is accumulating semiconductor positions. And you can also see it here with that chart we shared on the Thursday close video, which suggested that someone came in big time at the market close to try to buy up, or actually even the market open, to try to buy up semiconductors. And this was only about an hour into trade, and there was a massive transaction going on. Last time we saw this level defended, semiconductors went on a pretty good run. So it's fair to say that at least someone is trying to buy the dip right now. Now, we've looked at the cycle analysis. We know the Russell 2000 could do better over the next 3 to 6 months. And we also know that while the next 6 months look good, the next 12 months start to get more murky in a lot of the data reports. Whaley Breadth Trust is really good, but some of the others were a bit more murky on the 12 month. Does that make sense to where we are possibly in this cycle? Well, I think it does. First up, it kind of makes sense with the sell-off that could be there at the beginning of 2025. If you notice here, the actual return of the 1982 to 2000 run had this epic sell that came through near the end. And we might be on store for that. I think we're actually in store for that in 2025. After we see what happens with these elections, that could actually be one of the most volatile times, that January into March period. Let's look at the rotations from Wall Street. Could that give us any idea or inkling into what's been occurring? Well, we know big tech and semiconductors have been down. And meanwhile, we know that the overall health of the market is very good. We've got financials, we've got regional banks, we've got home builders, all absolutely flying over the last 5 days. And that's a great sign for the markets to actually be seeing recovery. And of course, for people to be looking at this dip as maybe a little bit better than other dips have been in the past. Why? Well, they're not really that scary. It's the most bullish kind of sell-off you've seen in a while, with semiconductors doing poorly, which they needed to come back, and smaller caps really coming through. ITB, home builders, 3.44% on the Friday just alone, really showing the strength of this market. And pretty much everything was up. It was a full breadth day where everything was recovering. And that's what leads a lot of people to say, well, was this a dead cat bounce? Generally, during a dead cat bounce, you would see one other thing that's a bit more interesting, which would be semiconductors, the most oversold market, should have been leading during that session. And I think that is something that a lot of people discount when they're looking at it. Doesn't mean it's a 100% guarantee, but it would be something I'd usually look for. I would look for a dead cat bounce showing a buy everything market, sure, but specifically buy everything that's been underperforming the most. So let's take a look at the S&P 500 this week. It was a very interesting chart, and it came down to the 38.2 fib, the anchored VWAP, and of course our trend line, leading us to believe, along with dark pool liquidity, that we were probably going to see a bounce regardless of how bad that candle looked. And as we zoom it in, you'll see how bad it looked. It closed on the low, it had a wick rejection after it rallied, and it didn't look very fantastic at all. And a lot of people were calling for the 53.75 gap fill. While that still may be on the cards, and it's something that I would put in the charts, 5300, 5350, all of this area in here, it is a very, very, very bullish zone. A lot of trading and a lot of similarities to the previous pullback. If that had happened, we'd move around 6% down. And if you take the length as well, you'll notice that they are very, very similar. Now, this is probably the case scenario we've talked about the most as a possibility, although I do think for semiconductors, it might be an improbability, as they look like they kind of flash crashed this week and led people to lose their positions. It looked like that kind of normalized thing that you would see when you're trying to take people's stop losses out and leverage them. And Wall Street's very good at doing that, of course. But what about now when we go, will we see a recovery? Is this a dead cat bounce? Is it a real recovery? What would we expect? Well, I would usually expect a new high, and we didn't get one. We saw 54.92 get almost tested throughout the session, and it failed to break up. And this leads us into looking at the options and, of course, the futures market. You'll notice the futures market got even a little bit higher. It tried to breach out, failed to do so, and now it's stuck in some structure. So that opens up a few positions. The first one is, what happens if we get past 5,500? Is that very bullish? I would argue it's certainly quite bullish, and it may even mark the bottom of this current market. The other point is, if we do get there, where's the next problem? Well, it's going to be at this most traded zone at 55.55. There's also a gap there left from Google's earnings and Tesla's earnings that ended up dropping the market. And I think this is a very important point that we all need to be looking at this week as a trader, whether it's bear or bull. If the bears are going to come out, this will be the point that they're going to come into. Swing traders will be looking for a closure above 55.85. And bears themselves will be looking to try to retrace down to 53.96. Although our base case here really is that even if we get down underneath here, 5350 or 5300 should act as pretty good buy pressure. So we got very close to really the most we could expect. And do remember, if you look at a weekly, what that would give us is it would give us a weekly 20 moving average and a similar pullback to last time. And in Elliott wave theory, it could actually begin the fifth wave. So yeah, even if it goes down a little bit more, it won't be that much. You would have to think based on the charts. Do the options agree with that though? Do the options think it's going to be relatively shallow right now? Well, the options are continuing to stack in the puts behavior, and we know that 0DTEs rule the world of the markets at the moment. So on the 29th and the 30th, where are all the options? They're all sitting at 54.10 to around 54.60. You'll notice here what's happening on the Monday session, and then you'll see also on the Tuesday session, huge amounts of puts sitting around these zones. Now, because we are in currently negative gamma situation, if the markets do end up taking 54.10, that could create that further cascade effect to the 5350 or 5300. So 54.10, that area will be very important to watch if markets do end up flash crashing into those zones through the Monday and Tuesday. But these ultimately should hold the support. And the reason we like 5300 so much is take a look at this point here. The 16th of August has a lot of 5300 puts on it and a lot of 5410 puts on it. And both of these being the OPEX of the month, the third options expiration of that particular month, and therefore holding pretty much most of the overall options trade, they can act as what we call put walls. And these points, along with the technical analysis, I think suggest that the market may not want to go that much further down. Of course, it's an evolving situation. We'll look at it as we can. What about the CTAs? Were they buying? Were they looking at it? Well, this is a delayed chart, but we know that CTAs were dumping into the event. And CTAs helped us to kind of not only show continued weakness through the pullbacks of 2023 and even earlier in 2024, but they also showed massive turn points. We're looking for CTAs to come with price action. So we'll get those particular results in a few days. We'll have them here on the channel, so make sure to sub for those. NASDAQ, even worse. You can see here the NASDAQ was getting crushed, and that was being represented on the charts. The charts, of course, also got crushed through this event, and this is something that also happened near the end. We got this massive crushing of CTAs, probably a bit of leverage happened, and then they automatically came back up. We saw CTAs join in on the trend. We will be looking for that join along with the price action. Other markets, Brent CTAs saw a little bit of an uptick. I still think that Brent is at a very pivotal point here. Even with the Friday sell-off, energy stocks still managed to get a little bit of gain out of them as well. Copper, that's starting to look so oversold that I could see the CTAs coming back into it. And gold is still up, down, and all around in terms of what the CTAs are doing. Let's move on to some of the other stocks. What about NVIDIA? NVIDIA doing quite well after going down to 108, found a bounce. We know 110, 112 is stacked on puts. So this has always been where we thought that technical zone was. We've had it over on X. We posted it there. As it came underneath that zone, I posted this is an absolute mega bull zone because, of course, it looked so oversold and it was just underneath our key level. And right now, it seems that everyone is trying to call strike around 122. So we'd have to think that if NVIDIA does go bullish, it's probably unlikely to go through 122 for the coming week. If it does, then, well, we need to pay attention to, positive gamma situation from negative. But I think NVIDIA, we've got the key levels. 122, 110, stay somewhere in between that, all okay. Go underneath 110, starts to look a lot more negative. Move over to Tesla now, 235 is the key level. Spot price currently trading at 220 as the close. And really, it's that 200, 210 that we know that has most of the puts on it. And you'll notice as we go out, we look at, let's say the 9th of August, the 220, the 215, the 210, and the 200s all have quite a lot of puts on them. So will we get through 235? If we do, could start a nice rally for the markets. But I would probably expect Tesla to stay underneath 235 this week and hover and maybe even fall down to around the 210. It could still see weakness because remember, it hasn't pulled back enough to give us that great technical zone. The 61.8 fib on the previous move up. The VIX, it dropped to 16.38. We know that usually during a major correction, we'll get a 20 VIX. We did not see that this time, and I generally do expect it. So sometimes this is what happens. You get this kind of flash sell, markets go back into feeling good about themselves. And as we saw last year in October, we ended up getting a new low from that point, and that bought us the VIX 20. VIX 20 easily achieved during April of this year, but not quite yet. So you've always got to keep that in your back of your mind. Are we going to get, let's say it does recover, are we going to get a third sell-off, a third partial correction in the markets? Volatility of the VIX can sometimes show us that. That dropped as well though, so no extra signs there. And junk bonds are looking really good. Junk bonds loving the market. KRE regional banks loving the market. And of course, XHB and ITB home builders also doing really, really well in the markets. US yields, this is the recession indicator a lot of people are screaming about at the moment, not quite underneath the overall uninversion target of 1%. We'll alert you when this happens, but as we know, it really is what the market does a few weeks after that uninversion that we need to be watching the most, because there are certain paths that Wall Street will take, whether Wall Street thinks a recession's coming, no recession, or more of a trap. Move over to copper, 75 fib retracement. Absolute extreme oversold market. Little bit of a rally here through the Friday session. Probably not enough to really get involved in. Maybe above 418. Copper's certainly only for the brave at the moment. It has been dropping and dropping and dropping consistently now since it broke through those levels. But I would say this is a point where I would expect bids to be caught. We talked about it in our previous video. Go check that out if you're interested. What about the US dollar? Well, it did nothing. I'm even surprised it did nothing. It sat, it did absolutely nothing, and it continued to coil. And what this suggests to me is when the dollar does make a move this coming week, it's probably going to be a fairly large one. Do we break to the upside or downside? I guess the market would currently be saying downside because the trend is still down on the overall track. But yeah, dollar index needs to kind of fall below this point. And of course, if it gets below 103.57 again, I would say it's very, very negative. And we might even be moving towards a 101 on the US dollar. What about gold? Well, gold had a okay week, I guess, in the end. It ended up as a long leg doji after seeing this terrible sell-off the previous week. I'm not won over by that being as negative as people think. A lot of people are negative on gold, and silver. Heaps and heaps and heaps of people. I believe it wins in many situations. If we go into stagflation, gold should do well. If we get interest rate cuts, I believe gold will do well, as we are in a currency war as well. So we've got central banks buying it. We've got a lot of bull cases. And also all of those, we do also have the lost decade. Gold has underperformed for well over 10 years. Most gold bugs have been wrong for 12 years flat. And that's one of the other reasons that I like it so much. When something has returned so poorly for so long and it has those right signals to go with it, you tend to see a significant overperformance. And that's what's taken us to gold being the best major asset class, if you're not including Bitcoin, of 2024. It's been absolutely incredible. Anyway, did it find a little bit of buying at the bull zone possibility? Yes. Swing zone traders, 24.32 this week. We're looking for a close above that. And I think day traders and smaller traders that are looking at picking up positions might be very, very happy with this 23.82 zone, because if we get above, which we are now, so 24.32 for the swing traders, this 23.82 level is quite significant. It's showing the first signs of, again, some recovery. You've got to be careful on these zones though, because this is what happened last time. We got that bullish move, which we expected, and then it ended up dropping through. So initially, very, very good signs for gold, and that's going to hopefully lead into GDX and other gold stocks starting to perform a bit better, because they came back and filled their gap last week. And the most important factor here really was just that they fibbed off. So when we look at the overall market and you take the distance here, you'll notice they got very, very close, if not hit the 61.8 fib, which is a great kind of like a great point to be looking at that dip kind of purchasing. Silver, what's going on here? Weaker than gold, that's to be expected. Silver bulls won't be super bullish above until 29.50 is hit. Didn't quite get to my level of 27.20 or 26.50. They were really my buy zones for silver. So unless it gets to those points, it's very difficult for me to re-add to this position or anything like that. Or I'll see a 29.40 plus, and then we can look for nice buying. So silver, not as strong as gold on the charts. US oil, well, it had a fantastic Thursday into a terrible Friday. and it continues to fail at a lot of these levels. Now, I've got a close above here as bullish at 79.16. I still think that's the best point. And if it does manage to get above that, I think XLE and oil could fly higher. So watching this one, very worrying Friday though, bit strange. We'll see how it ends up through the next week. And the weekly, of course, closed into the golden pocket itself. When we move over to XLE, still looking good, much better than overall oil. You'll notice it's kind of found its own bottom trend line support. And then, of course, we've got our top trend line as well, plus the action that's starting to show some recovery in energy stocks. Tesla stocks, as we mentioned with the options, the key really is to get a 210 out of this. It's in the middle of nowhere land at the moment. For some bull traders, if you end up getting a gap up, that could be a good island reversal sign, and maybe you're going to be quite happy. You also may think, well, we got pretty close to properly filling this gap here, so that's enough of a pullback. I would say wait for more. Patience will probably be the key here with Tesla, and I'm sure there'll be a good trade coming for it soon. If you're still short it, I wouldn't blame you. 210 would be the target. NVDA, decent bounce. Certainly came off that 108 level very nicely. 110 also held. Didn't end up closing at a new high, but it did end up positive overall. And if you wanted to look at when is the swing trader going to come in on this, when's the really big money going to come in, there are two main levels. I feel like the big money will come in around 125 and around 117. Now, 117 is certainly a lot more questionable, but that will take the high of Thursday out. And I think that high of Thursday will be a big deal, especially if we close above that point, showing that this wick was really big Wall Street purchasing. And you'll notice here, the volume that went through there was quite large indeed. Let's move over to the UK 100. Beautiful trade. You got into this one. Yeah, it's really good. And it actually suggests, considering how long this is coiled, that this might be flying. So if that's true, the UK is made up of really three main things. You've got your energy stocks, your materials or metal stocks, and you've got your financials. So again, the kind of backbone of the UK economy is in many of those things. And yeah, this chart is really suggesting that there's a big move going on there. Another one that you'll want to look at when you're checking out the UK is usually Australia, because in many ways, Canada and Australia, they both have similar economies. And again, you'll see the same thing. Big, strong rejection here from the Australian market after making a move back down. They actually held the daily 20 moving average and closed above the long leg doji. They're all good signs for those international markets. Now let's move over to the US though. The increase in breadth of IWM, this orange chart, versus the Qs. And I'll move this over to a line chart so we can see them both together. And maybe we'll remove this as well. We don't need that there. So why I want to bring this up is because you might notice that they're getting closer together. We've got rotation out of big tech, rotation into the smaller caps. And the smaller caps have been sitting for quite some time. So think of this as a massive pit, a pullback in time, and this is now time for them to overperform. Meanwhile, what's been happening? Big tech has been going for quite a long period. Now, we've seen this a few points. We saw this back in 2023, where we got that pullback in time, and then all of the markets actually blew up. Now, this wasn't anywhere near the size of this pullback, though. So it takes a while for us to go back and look for those. But what it tends to suggest, if you look at some of them, is either you're really close to the end, like this one here in 2021 with the false break, or you're in that final kind of stance of big runs. So here's another pullback, let's say mid-cycle of this particular one, where we have a big significant overperformance. Then we have a pullback in time or an underperformance of big tech. And that leads to, of course, the Russell 2000 doing very, very nicely. I always believe that it's kind of that sign that you're getting close to late cycle. So you're moving into that last 6 to 18 months of the market when you see this type of thing. And that seems to be where we possibly could be based on the data, based on the stats. Is it a negative thing? No. Could we see the Russell 2000 outperform the NASDAQ? It is very possible because that's what Wall Street's actually believing. Wall Street's saying, we need earnings out of Russell 2000. We need them now, guys. If we don't get them, then we are going to be completely, overselling this market because all of their growth curve that they're really looking towards is Russell 2000 growing in 25. They're looking for that more so even than some of the big techs holding up. What about the NASDAQ then? Was the NASDAQ shown signs of recovery? Well, it didn't break above 19,230, which is, I believe, the first kind of day trade turn point. And if, again, we get that, we're probably pushing towards the gap fill. which sits around 19,750. So good signs if that happens. On the daily, we managed to hold and hold as a green candle, which is good on the futures. And you'll notice on the weekly, it bounced off the 20 weekly moving average, the mean reversion. So from top to bottom, if we measure it, you are actually still getting on the NASDAQ an 8.62% discount from where it was and almost that 10% correction at 9.77. That's not a bad price. And considering the dark pool transactions going through on semiconductors, we have to be paying attention to that. You'll notice semis also managed to hold the 20 moving average on the weekly, which is the most important point. And across the board, if you don't consider just NVDA, it didn't quite make that new high, but you'll notice it did close above the overall semiconductors doji that was formed on the Thursday. A very interesting point here for markets, and specifically, you'll have to be watching them all, including how NVIDIA ends up trading throughout this week. Let's move over to the Russell 2000, definitely the best looking market. And I want to go to IWM, which is the ETF of this, and you'll notice that it closes, not above this wick, but it closes pretty strongly. Now, this suggests that we could be moving on to our next level. Now, if you know Tom Lee, he has believed that the Russell will get to 300. So basically, it's going to go all the way up here by the end of the year. Now, if we take that distance, that is actually a significant overperformance, 33 to 34% from where it is right now. Now, I don't know if it'll get that high over that period, but we do know based on some of the stats and data we shared before that if the Russell is truly overperforming here, that it should do pretty well, because every other time when we get these breakouts, when we get these things, it tends to do very nicely indeed. For now though, 24 kind of 50 is where I'm looking. So for the market, it does look like it kind of is trying to break out. It's very marginal, so you will want to see new highs being formed this week, but this is pointing towards a 24.50 and pullbacks to be met by bull demand. So again, it's kind of like the most bullish bear sell-off we've seen in a very, very long time. Let's now move over to Bitcoin. Fantastic movement on Thursday, fantastic movement on Friday. No new high yet. Big dark pool transaction coming through. To me, it kind of has all of those hallmarks of still a very bullish market. And we've spoken about this all the way since down here. And we've basically said, yes, it's bullish the whole time. Why? Well, it just had all those traps. And if you think about it, this is the number one trap area. So if this is part of, let's say, a Wyckoff, we could consolidate here for a while. We could also breach out, not go ballistic, sell down, creating what we call an SOS, and then rally back through. So I think all things kind of point towards a decent period of time here for the crypto markets. And the main reason is as well is because we get that nice bullish pickup on Bitcoin. Also, Ethereum not faring anywhere near as well, even though it's getting the ETF. So again, it's the buy the rumor, sell the fact. For the market news for the week ahead, we've got the JOLTS job openings coming out. And then, of course, we have some other big data for places around the world. We've got CPI, we've got the Bank of Japan policy rate, which does matter. A lot of people believe the US dollar yen and the markets are connected right now. And then we have core CPI coming out for the Eurozone as well. The big one for the US is going to be the federal funds rate, which some people believe there's a rate cut coming. I don't know about that. And the FOMC statement, which is at 2 p.m. Remember, sometimes the statement can come out, the market goes off in one direction, and then the press conference happens and the market goes in the opposite direction. So be aware of that. Bank holiday for CHF on Thursday, and then we go into the big one, in my opinion, which is non-farm payrolls. And that's on Friday. And this will show us whether the economy is hot or maybe it's not so hot right now. Has unemployment actually started to spike? Are jobs still going through? It'll all be coming your way this week, guys. Join us as we can do that together, and follow us over on X as well. Check out anything else we've got. And if you're interested in finding out more about how we replicate trades, create these cyclical analysis concepts, and of course, understand many times the monetary system in a totally unique way that's actually being, if you can believe it, taken out of some of our education books, then check out our advanced masterclass. Thanks so much for watching. You have a great weekend, and we'll see you after the Monday close. Bye for now.